Jaideep, as I mentioned, compared to its Western counterparts, where the passive fund segment is still it's very well established, India still has some catching up to do. So I want to hear from you, what could have been the deterrence and how can fund houses change that?
Hi, good afternoon, everyone. Thanks for having me on the panel, first of all. I think there's a couple of reasons. One is, let's say, a positive for the US. We've got to remember that, the whole idea of passives was should I say, the brainwave of one person originally, the founder of Vanguard. And from there, it kind of grew and kept growing as index investing caught on and so on and so forth. And then over a period of time, passive funds tended to outperform many of the active fund managers as well, which then created a multiplier effect. In India, there has been no such single trigger, so to say. I think the other thing is that, if you see the push that the industry itself has made, and indeed the messaging from the government, a lot of it has been around just attracting people into the stock market, with the highly successful sort of Sahi Hai campaign and the constant reminders from SEBI about the goodness of investing in stocks and so on. I think so. We've got a first wave, and it's worked beautifully. And my congratulations, to my colleagues from the industry for that. I think now, as investors get more and more used to different strategies, some of the other panelists have spoken about it. You will find that some part of their allocation will end up in passives, and then over a period of time, passives will have their place in the sun, as will actives and other asset categories. So that's those two. I think factors are probably the reason why it's taken a little bit of time to take off. But I think there's, should I say, roseate on brighter days ahead here.
All right, brighter days ahead, an optimistic outlook from Jaideep, and we look forward to when it becomes a sort of a regular part of the portfolio and becomes a regular part of financial strategies for a lot of investors. But on that note, Kaustubh, what kind of time frame and goals are passive funds most suited for? Let's get down to the brass tacks. Say the investor is sold on the idea of passives, but wants to understand, from a perspective of time frame and meeting financial goals, where does it fit? Your thoughts on that?
Sure, Gautam. And I think my fellow panelists touched upon a lot of important points that the industry has been developing, for the last many years now, and I think the last couple of years really been pivotal in terms of even passive fund offerings, right? That traditionally we've always had our standard broader market indices, but the last couple of years we've clearly seen a lot more come. Like I said, fixed income. We've seen a lot of thrust in the last few years. International ETFs have only grown, and we've kind of been kind of deepening sort of say commodity ETFs through regulation. So I think a lot of good strides have been made by both the regulations and the industry participants. Right, when you think about the bouquet that's available, and obviously there's a lot more scope for expansion, but I think it's an interesting mix, right? I mean, you can, for an investor, you have something as easy as a liquid ETF that's also available if you want to park money away for a very short term. You need that in just a few days or a week, 10 days. So that's an easy sort of thing that's available to an investor, all the way to your diversified sort of bond, equity funds or bond ETFs, which can really be used for various different time frames, right? So let's give an example of, say, the fixed income funds, which typically come, and most of these passives are with like a target maturity. So as an investor, I can look to pick a fund which I'm comfortable parking my money at today's yields, with a certain time frame in mind, where I know that I will, I'll minimize the amount of credit risk given the mandate of the funds and where they invest. I know upfront what's happening, and also because it's a maturity at a certain point of time, my interest rate risk is pretty well mitigated or minimized, right? So I think that's an interesting way of looking at, from, like I said, liquid funds for extreme short-term parking to going up to depending on a time frame, even 1, 3, 5 years, depending on a passive that you can pick. On the fixed income side, you can buy that way. Then you come to your commodity and your equities. Right now, commodities, we know that traditionally we've been gold has been a very popular asset class that people have held in a physical format, but there is merit in using that as a portfolio diversifier, as risk diversifier. When we've seen there's a risk off trade globally, it plays a good risk diversifier in your portfolio, and gold ETFs are a brilliant way of playing that, right? And then when you think about ETFs, your equity ETFs, which is really the bread and butter right now in terms of constitutes the largest assets in the industry. again, it can have multiple roles within your own portfolio. I would say it should be a core part of every investor's portfolio because, like we said, if you're looking for various goals, retirement or building for your children's education or any sort of goal which is long term, and when I say long term, ideally 10 years and more, but even 5 years plus in some of the broader horizons, broader market indices is okay. You can really use that through a passive index fund, more diversified one, because that can really help you not worry about how's the fund manager doing, is there a change in manager, is there a change in style, really look at is there underperformance. It's almost like a fill it, shut it, forget it in that sense. You buy it and you just hold it for your time horizon. Then there's that last bit of the sectoral or the thematic ETFs that come in, right? And that's the interesting bit where a little more savvier, nuanced investor, he or she wants to take an exposure. I think in the earlier session, Mahesh spoke about that there are sector rotation happens, and if there is an investor who can take that call or is willing to put some money on the table for a certain part of the portfolio, I would say more like a satellite allocation to a portfolio, can think about looking at some of the sectoral ETFs, for instance, for taking exposure to say a banking or a healthcare or IT. But mind you, the risk in this is a lot more, given that like we said, sector rotation. So you need to be a little more nimble in your approach. And only take that as a satellite allocation in your portfolio. So I think the passives, and sorry, I forgot to mention international ETFs, and how can I not talk about that? That's the other bit, right? That moving away from home diversification to international diversification can really be done through that space obviously is has grown quite significantly. There are some challenges which we'll probably talk about in terms of limits on the AUM that they can manage right now, given the regulatory constraints. But broadly, I think that's another interesting way of building that. So I think a reasonable gamut of offerings is there. This is only going to grow. But from an investor, from a day to long-term planning, you can really get a lot of ETF offerings that are available to investors right now.
An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.